Most investors treat their portfolio and their tax return as two separate silos. They chase a high return without ever thinking about how much tax they'll need to pay. Keeping these two things separate will probably cause you to pay way more tax than you need to. But you can build a wealth engine where every move lowers your tax bill while growing your net worth. I've seen a pattern with couples that create a true legacy for their family. It's 5 steps that bridge the gap between your broker and your CPA. Miss a step, and you're overpaying the IRS. I'm Ron Bristol with Advanced Wealth Advice with another personal finance hot take. In today's take, I'll give you 5 steps you can take to control your taxes in retirement. Step number 1 is simply awareness. Most people wait until February or March to think about taxes, handing a pile of tax forms to their accountant and asking, "How much do I owe?" This is the year-end scramble that turns your tax pro into a historian who's just there to calculate the damage. This fails because by the time you see your tax forms, the ink is dry. You've missed the deadlines for moves that really matter, leaving you with basic deductions that can't offset significant gains or income. Instead, look for an advisor that builds forward-looking tax integration into their service process. This means every change to your portfolio is vetted for tax impact. Your taxes are managed intentionally and not just as something you have no control over. In practice, this also means running a pro forma tax return mid-year. If you have a $20,000 gain, don't wait around for the tax bill. Your advisor should look for losers in your taxable account now, sell them to harvest the loss, and balance out the gains. This simple coordination can save you thousands of dollars, but only if you're using an advisor that acts while the window is open. Step number 2 is putting your investments in the right tax bucket. Most people buy the same diversified funds in all of their accounts, their Roth IRA, their 401k, and their brokerage account. This feels diversified, but it's incredibly inefficient. This fails because different investments have different tax rates. A high-yield bond fund in a brokerage account means you pay ordinary income tax on the distributions, and these are often the highest rates on your tax return. A high earner could lose nearly 40% of their yield to the IRS. Instead, match each investment's tax profile to the account's tax status. Put tax-expensive assets into deferred, or better yet, tax-free accounts, and tax-efficient assets into accounts that are taxed every year. For example, a client with $1 million portfolio across an IRA and a brokerage account should place corporate bonds in the tax-deferred IRA. The interest grows shielded from ordinary income tax until you withdraw that money. Stock funds should go into the brokerage account, where gains and dividends are taxed at lower long-term capital gains rates. And high-growth potential funds should live in your tax-free Roth accounts to keep 100% of that growth away from the IRS completely. Simply swapping the location of these assets increases your after-tax return without taking any more risk. If you realize your portfolio lacks a real tax plan, let's talk. Click the link in the description to schedule a strategy call where we'll find these hidden leaks in your specific numbers. Step 3 is Roth conversions. Now let's talk about the Roth conversion ladder, usually the most powerful tool you have. The common approach is letting your 401k or IRA grow as large as possible, ignoring that the IRS is actually a co-owner of that account and will take its cut. The problem is that this becomes a huge tax bomb in your mid-70s when required minimum distributions, or RMDs, force massive withdrawals, pushing you into the highest tax brackets of your life and triggering higher Medicare premiums. The better move is to fill up lower tax brackets with strategic Roth conversions. You move money from the tax-deferred accounts to a Roth IRA, paying tax at today's known rates for a lifetime of tax-free growth. And the method matters. Don't convert all at once. Look at your tax brackets. If you're in the 22% bracket with $30,000 of room before the next bracket, you convert that amount. You're buying tax-free growth at a discount. Doing this over several years dismantles a huge future tax liability. Now, step 4 is smart rebalancing. Most people don't know about rebalancing drag. When markets run, a 60-40 portfolio, one that has 60% in stocks and 40% in bonds, can drift to 70-30 because the stocks have naturally grown faster than the bonds. The common fix is selling winners to buy the losers, which brings you back to your 60-40 target. This fails because selling winners in a taxable account triggers capital gains tax. You're paying a success tax for being a responsible investor. Over years, this drag compounds into a massive loss of wealth. The better move is cash flow rebalancing. Instead of selling, you use new money or accumulated dividends and interest to buy what's underweighted. To do this, stop automatically reinvesting dividends in your taxable account. Let them collect in cash. Then use that cash to buy your lagging assets. If your portfolio has shifted dramatically and still needs to be rebalanced, do it inside your tax-sheltered IRA or 401k. This keeps your taxable accounts growing without leaking taxes to the IRS. If you worry your advisor is just picking stocks without looking at your tax return, it's time for a second opinion. Visit the link below to see how we build these tax strategies into a custom wealth plan. The last step is giving smartly. If you're like most people, you write checks to charity from your bank account and will eventually leave your taxable IRAs to your kids. This is really tax inefficient. You're giving expensive after-tax dollars to charity and leaving a tax-burdened IRA to your family. Your kids will pay income tax on that inheritance, and probably a lot because they're getting the money during their highest earning years themselves. The right way is to flip that. Give tax-heavy assets to charity and tax-light assets to family. And if you're over 70 and a half, use qualified charitable distributions, or QCDs, to send money directly to a charity from your IRA. The specific move is using your RMD to fund donations. This money never hits your tax return, so it doesn't increase your adjusted gross income or trigger other taxes. Then leave your Roth IRA or taxable brokerage accounts, which get a step up in basis at your death, to your heirs. Your family gets the money tax-free, and the charity gets the full amount. It's a win-win. Now, wealth management isn't just about picking stocks. It's about how much you keep in the long run. If you have over $500,000 to invest and want a professional eye on your tax efficiency, click the link in the description to schedule a call. We'll walk through your situation and show you ways to lower your lifetime taxes. You can also visit us at www.advancedwealthadvice.com to learn more about what we do. Thanks for visiting our Hot Take videos. I hope that you finish each one feeling a little smarter than when you started. Thanks for watching and have a great day.